Welcome. Today's session is about accounting for climate and how climate matters affect financial reporting. My name is Jose Hopkins, and I'm a chartered accountant and sustainability consultant, and I've worked across sectors for more than 16 years preparing and challenging climate-related disclosures under IFRS and UK GAAP. Today's is not going to be a theory dump. My aim is to share what I've seen in practice, the questions that CFOs, boards and auditors are already asking, and how climate is shaping accounting judgments. So here is our agenda for the session today. First, why climate is now unavoidable in accounting. Second, where does climate show up in your numbers? Third, looking at materiality through two lenses. Fourth, ISSB readiness for finance teams. Then part 5, we're going to be covering some case studies, IFRS versus FRS 102 in practice. We're going to be having some guest insights from Stephen Pell from NeoEco and some key takeaways. I'll take you through the first 5 parts, then Stephen will share you his practical insights, and finally we'll wrap up with what can you do next. So a little bit about me. I'm a chartered accountant, previously with KPMG, and worked with big clients such as Syngenta, BHP Billiton, Rio Tinto, Cass Minerals, and Ferrexpo. And my focus is helping finance teams bring climate and sustainability into financial reporting in a way that's proportionate, practical, and audit ready. I also lecture at the University of West London on sustainability frameworks and disclosures. And what I've seen consistently is this: climate is no longer just a sustainability reporting issue, it's also an accounting issue. So to set the tone, I want to start with 2 statements. First, on the left, from the FRC's fact sheet number 8, updated in March 2025, where it says that entities must consider climate-related matters when they could have a material effect on significant judgments and estimates, such as impairments, provisions, useful lives or going concern. And on the right, we have the IFRS Foundation, where it notes companies must consider climate-related matters in applying IFRS accounting standards when those affects those matters in a material manner. These aren't new rules. There are existing requirements being sharpened. What's changed is that silence is no longer acceptable. So I want you to consider, has climate already influenced your estimates? And here are 6 questions to test yourself. For instance, useful lives. Do you have a building carrying out 50 years that may need retrofitting sooner? Impairment. Do your cash flows assume steady demand, or would carbon pricing cut margins? Provisions. Could remediation or decommission costs arrive sooner than expected?